Welcome, dear traders. You are watching a recap of the Asian session. The Fed meeting holds the spotlight today. Yesterday, Wall Street climbed amid a rise in shares of tech, materials, and communication services companies. However, it did not affect Asian stock indexes. The Japanese stock exchange started Wednesday in the red. Australian and New Zealand indexes climbed mainly because of an increase in the stocks of commodity companies. The shares of the largest iron ore producers in Australia rose following China's promises to stimulate its economy. Policymakers pledged to do so at a recent meeting. However, there have been no results yet. They also did not provide any details about the possible stimulus measures. The media reported that the central bank would implement prudent monetary policy in a precise and forceful manner to support economic growth. The authorities are likely to provide financial aid for manufacturers and the property sector. If so, it will be favorable for stocks. If the government provides assistance to consumers, stock markets will hardly benefit from it. In anticipation of the stimulus measures, stocks of commodity companies as well as commodity currencies that have been somewhat bettered in recent months have resumed growth. Asian stock markets showed weaker results on a Wednesday ahead of the Fed meeting. The regulator is expected to raise the key rate by 25 basis points today after the June pause. Moreover, the majority of investors consider this step as a done deal. Thus, the main focus is switching to forecasts. Given that core inflation remains stubbornly high, the Fed is unlikely to make drastic changes. Yet, the chances of a further tightening are also low. The regulator will hardly cut the interest rate until the end of 2023. However, it could also take a pause after a rate hike in July. The Fed's final decision will depend on incoming data. It will hold 3 meetings this year on September 20, November 1st, and December 13th. If the Fed predicts a further decline in inflation and the US dollar may weaken even more, it's clear to everyone that the tightening cycle is inevitably coming to an end. Thanks to a hawkish stance, the greenback reached its 20-year high last year. In addition, economic growth in the United States and some other countries turned out to be stable, and this significantly lowers the risks of a global recession. It has facilitated risk appetite. It was another bearish factor for the US dollar. It fell to 101.20 versus its main rivals. The yield of a benchmark Treasury notes was mixed this morning. On early Wednesday, 10-year government bonds rose compared to Tuesday's close. At the same time, 2-year bonds, which are very sensitive to monetary policy prospect, dived. The greenback was moving in a narrow corridor of 101.10 and 101.40. Still, it's too early to talk about a prolonged downtrend. If inflation turns out to be persistently high and the Fed sticks to a hawkish stance, the US dollar may rebound again. While there is some uncertainty about the Fed's future plans, everything is quite predictable when it comes to the Bank of Japan. Kazuo Ueda once again stated that there is still a lot to be done before inflation reaches the 2% target. These comments mean that the regulator does not intend to change its dovish stance in the near future. Nevertheless, market participants received hawkish signals from another source. The Bank of Japan should start preparing for future monetary tightening. International Monetary Fund's chief economist Pierre-Olivier Gourinchas said on a Tuesday, "Our advice for Japanese authorities, there is a that right now monetary policy can remain accommodative, but it needs to prepare itself the need to maybe start hiking, Grinch has told in news conference. Given the hawkish comments and the weakness of the US dollar, the dollar-yuan pair slid into a downward range of 140.20 and 141.20 in the morning. The yen continued to grow even despite an increase in the yield of US government bonds. In the Asian trade, it was trading near 140.30. Apart from that, a fall in the US dollar boosted demand for other safe haven currencies, especially the yen. In the case of a breakout of the support level of 140, the pair could retreat to 139.40, the low of mid-July. The potential downtrend of the US dollar made commodity countries more attractive to investors, especially the Aussie and the Norwegian krone. After the peak levels in 2022, prices for oil and other commodities have tumbled markedly due to the threat of a global inflation. Due to the aggressive tightening by central banks, exports of the commodities have decreased significantly. The situation is improving now. Commodity assets are growing again. However, still a rise of a Australian dollar had stopped because of internal data. According to the reports, annual inflation in Australia declined in the second quarter to 6%, the lowest figure since the third quarter of 2022. For the Aussie, slowing inflation is a bearish factor. After all, the Reserve Bank of Australia could skip a rate increase again. Inflation is moving in the right direction, Treasurer Jim Chalmers said today. However, he also warned that there is a long way to go to beat inflation. These comments helped the Australian dollar recover within the range of 0.6734 and 0.6796. Given the fresh inflation data and lower oil prices, the Aussie lost ground. After slight consolidation, it ended the Asian session with a drop to 0.6166. And the New Zealand dollar was also trading volatile in the morning. After rallying in the previous two sessions, the Kiwi dollar pair was moving between the resistance level of 0.6234 and the support level of 0.6184. Investors were cautious in anticipation of the Fed's rate decision. The Kiwi, as a risky asset, rolled back to 0.6123. And that's all for now. Hit the subscribe button and keep your finger on the pulse with us. See you soon!